Right. So, a pleasant day to all of my students in personal finance. This is the fourth lesson in our subject, personal finance elective 2. And I would like to discuss this and record this discussion so that we can still cope up with the discussion despite of my busy schedule. Of course, today we're going to talk about the lesson number 4, which is the monetary resources, which is another exciting topic in the subject personal finance. Okay, so this unit is about understanding money and investments. You will learn the difference between assets that involve money, monetary, and those that do not, those that are non-monetary. It also covers borrowing and investing, explaining different types of bonds and shares. Additionally, this unit will help you decide on good investments and understand the basic investment rules. And I hope you are excited to learn about monetary resources because, again, I will be discussing to you different good investments and understand the basic investment rules. Okay, at the end of the unit, I will be able to discuss monetary resources. You have to put that in your mind. This is the goal. Distinguish monetary from non-monetary assets. Identify monetary and non-monetary assets. You can already discuss debt capital market. You can already identify different types of bonds and be able to discuss equity shares and identify the different types of shares. So let us proceed to the lesson proper. Monetary resources are assets that are in the form of money or have a fixed value in currency such as cash, saving in the bank, or funds that are available for spending. These assets do not change in value over time, but you can lose the purchasing power when price of goods and services increase. That is what we call inflation. For example, if you have 1,000 pesos in cash, its value in pesos will remain the same. However, if the price of rice or groceries goes up, that 1,000 may not buy as much as before, unlike land or, of course, gold, which can increase in value over time. Cash remains the same in peso, but it may lose value in terms of what it can actually buy. Okay, so what are the characteristics of monetary assets? Well, let us first define monetary assets. Monetary assets are assets that have a fixed value in terms of money, like cash, savings, and accounts receivables. They don't change in amount, but can lose their buying power over time due to inflation. So these are the key characteristics of monetary assets, the change in real terms. Like the value in pesos stays the same, but what you can buy with it may change. If you have 1,000 pesos and the kilo of rice costs 50 pesos, you can buy 20 kilos today. But if the price rises to 60 pesos per kilo, your 1,000 will only buy 16.67 kilos, meaning your purchasing power has decreased. Another is the no changes in financial statements, unlike the land or buildings whose values may increase or decrease. Monetary assets like cash and bank deposits stay the same in peso terms in financial records. For example, if a sari-sari store has 50,000 pesos in bank savings, the amount remains 50,000 pesos in financial records. But if land was bought, let's say for example, 500,000 years ago, and it is now worth 1 million pesos, its value would need to be updated. For example, of monetary assets in the Philippines, cash, money in your wallet, or your cash register, bank deposit, saving accounts, let's say for example, in BDO, BPI, or Land Bank, trade receivables, money customers owe to a business, for example, sari-sari store allowing utang, investments in debt instruments, treasury bonds, or government securities. It could be lease investments, rental income agreement. Monetary assets are important because they really provide liquidity, but their real value may decrease due to rising prices in the economy. All right, so let's talk about characteristics of monetary assets still. But this time, let us talk about non-monetary assets. These are assets that do not have fixed cash value and cannot be easily converted into money. Their value changes over time due to factors like market demand, it could be technological advancement, or economic conditions. For example, some of the key characteristics of non-monetary assets, value is not fixed. Their worth changes over time. It is not easily converted into cash. Unlike money in the bank, these assets take time to sell. It is also affected by market conditions. Their price depends on supply and demand. Example of non-monetary assets, for example, land and property. A house in Manila may increase in value over the years. It could be equipment and machinery, a printing press. They may lose value as newer technology emerges. Intangible assets, it could be brand reputation or goodwill, like the strong name of Jollibee adds value to the company, but it is not directly measurable in pesos. It could be inventory, a grocery store stock of goods like canned goods or rice. It can fluctuate in price based on the supply and demand. We also have company shares, equity shares. If you buy stocks in SM Investments or PLDT, their value go up or down depending on the stock market. So imagine you own a karinderya. Your cash in hand, the monetary asset, is always worth the same in pesos. Your cooking equipment, non-monetary asset, loses value over time as it wears out. Your land, the non-monetary asset, it may increase in value if more businesses open in your area. But non-monetary assets are important for long-term investment, but they are less liquid than monetary assets because they take time to sell or it changes in value over time. So let's talk about what are the non-monetary assets. For example, monetary and non-monetary assets, we can say are both important in business, but they have key differences in how they are used. And of course, it is also how they are used and how they are actually valued. Now, you see, we also have here the different features of non-monetary assets. We can say that some of the things that you have to consider, for example, in the non-monetary assets is, of course, liquidity. It is easy or how it is easy to convert in cash. For example, monetary assets are easy to turn into cash, right? For example, non-monetary assets take time to sell because they can lose value if they are sold quickly. For example, again, sari-sari store, the cash on hand, those are monetary asset. They can be used immediately to buy more supplies. But if the store owner wants to sell the refrigerator, the non-monetary asset, they make time to wait for a buyer or lower the price to sell it quickly. Of course, we also have the cash conversion, the fixed versus changing value. Monetary assets have a fixed peso value like bank deposits, but non-monetary assets change in value based on market conditions. Example, if you have 10,000 in savings account, it stays 10,000. But if you own a piece of land, let's say in Cavite, its price may increase as more businesses develop in the area. Another is what affects their value. In monetary asset, they stay the same in amount, but they may lose the buying power due to the inflation rate. The non-monetary assets, they change in value depending on the demand. For example, government policies as well, or new technology. Example, a taxi business that owns traditional taxi, non-monetary asset. They may lose value if people shift to riding or ride-hailing application like the Grab. Meanwhile, the cash reserve, the monetary asset of the company, remains the same in peso amount. It can also be based on the role in business. Monetary assets help businesses with daily expenses, but of course, non-monetary assets help businesses grow by generating income over time. Example, okay, a restaurant uses cash, monetary asset, to pay for ingredients and employee salaries, but it depends on kitchen equipment, those that are non-monetary asset, to cook the food and earn income in the long run. So these are the difference between the non-monetary assets and the monetary asset. I hope you were able to understand the different features and the difference between the monetary assets and the non-monetary assets. But of course, some assets can be either monetary or non-monetary, depending on how they are structured in a contract. Two common examples are prepayments. Those are advance payments, and investments in preference shares. Like for example, prepayments, advance payments, if the advance payment is non-refundable, it is a non-monetary asset because you cannot get the money back. But if the payment is refundable, it is a monetary asset since you can recover the amount. For example, a business owners pay 50,000 pesos in advance rent for a small office space in Manila. If the contract states that the payment is non-refundable, the business cannot get the money back, making it non-monetary asset. But if the landlord agrees to refund the payment under certain conditions, it is considered a monetary asset because the money can be returned. Now, I hope you understand the difference. Another is investments in preference share. Like if the contract states that the company must buy back the shares after a certain time, it is a monetary asset because the investor is guaranteed a cash return. But if there is no redemption clause, the value of the shares depends on the market, making it a non-monetary asset. Example, if you invest 100,000 pesos in preference shares of Jollibee Food Corporation, if Jollibee promises to buy back the shares after 5 years, it is a monetary asset because you are guaranteed to get your money back. But if the shares are not redeemable, their value will depend on the company's performance, making them a non-monetary asset. So what do you mean? Refundable payments and redeemable shares are considered monetary assets, but non-refundable payments and non-redeemable shares are considered non-monetary assets. Okay, so let's talk about cash. Cash has been used for trading goods and services for thousands of years. Different civilizations used various forms of money, such as gold and silver coins, seashells, salt, and sugar. You were able to learn that from the history of money, evolution. Today, cash refers to currency, bills, and coins, and other forms of money. What can be used or that can be used for payments? What is cash? According to Valix et al. In 2012, cash simply means money. Now, it is the standard way of exchanging goods and services in business. Besides bills and coins, cash also include checks, bank drafts, money orders. The type of cash, like the cash on hand, money that a person or business has but has not yet deposited in the bank. Let's say a sari-sari store receives cash and checks from customer but has not deposited them yet. Or it could be cash in bank, money kept in a bank account that can be withdrawn anytime. Like for example, a business keeps 500,000 pesos in a BDO checking account to pay for supplier orders. It can be cash fund, like those that money set aside for specific uses. For example, a company keeps a petty cash fund of 5,000 pesos for small daily expenses like office supplies. Well, cash is not just a physical money, but it also includes bank deposits, checks that can quickly turn into cash. Businesses manage different types of cash to ensure they pay for expenses and investment. As you can see, cash is measured at face value. And foreign currency cash is measured at the current exchange rate. As you can see, these are examples, the coins and of course the bills. Now let us proceed to bank deposits. These are those money that people or business keep in a bank for safekeeping. When you deposit money in a bank, you can withdraw it when needed, depending on the type of account that you have. For example, demand deposit, checking account. A bank account where money can be withdrawn anytime using your checks. It does not earn interest. Example, a business owner keeps money in a checking account to pay suppliers by issuing checks. Savings deposit. Of course, a bank account where money earns interest over time pero hindi naman ganun kalaki, maliit lang din. The bank provides passbook for tracking deposits and withdrawals. For example, as a student, you can save part of your allowance to BPI savings account to earn interest. Diniscuss ko na sa inyo kung magkano yung mga maintaining balance sa iba't ibang commercial bank in the previous discussion. Time deposit, a deposit that earns higher interest but cannot be withdrawn until a fixed period ends. The bank issues a certificate of deposit as a proof. Example, a retiree invests in Metro Bank time deposit for 5 years to earn higher return. So the bank deposits, we can say that help keep money safe and allow it to grow through interest depending on the types of deposits that you have chosen. All right, so let's proceed to bank deposits. You can see the example of, you can see here the example of a check. Now you can see there the date, your name, of course, your account number, the list of amount, each item that you are depositing will be here. This is for the bank deposit slip. Some of all the items you've deposited, depende dun sa pinaka-bangko kung ano yung kanilang. Basta these are the basic information. Okay, so let's talk about trade receivables. These are all amounts that customers owe a business after buying goods or services on credit. Instead of paying immediately, customers receive billing invoice and promise to pay later. Business keeps track of these amounts in their accounts, receivables records. Example, a grocery supplier delivers goods to a sari-sari store and allows the owner to pay after 30 days. So the amount the store owner owes is recorded as trade receivable. How trade receivables are recorded? When business sells goods on credit, it is recorded as the debit increases. So you need to debit accounts receivable. Credit increases, sales. When the customer pays, the business records would be debit increase cash, credit decrease accounts receivable. Trade receivables are money businesses expect to receive from customers who bought on credit, utang. Managing receivables well ensures that the business have enough cash flow. And when a business sells goods or services on credit, allowing the customer to pay later, it records the amount owed as receivables. There are two types: the accounts receivables, money owed by customers without formal written promise to pay. It is based on invoice or delivery note. This is an unsecured loan because there is no strong legal document guaranteeing payment. Example, a wholesaler delivers soft drinks to a sari-sari store and tells the owner to pay after 30 days. The supplier records this as accounts receivables. Notes receivables, money owed by customers with formal written promise to pay called promissory note, the one that you are seeing on the screen. So technically, it is more secure than accounts receivable because it includes specific payment terms. Example, a motorcycle dealer sells motorbike on an installment basis and requires the buyer to sign the promissory note agreeing to pay 5,000 per month for 1 year. This is recorded as notes receivable. So what do you mean? Accounts receivables, credit sales without formal promise to pay. Notes receivables, credit sales, but there is a written promise to pay. Businesses must manage those receivables properly to ensure they get paid on time. So let's proceed to debt capital markets. As you can see, these are financial markets where companies borrow money from investors instead of selling ownership or the stocks. In simple terms, business issue debt securities like bonds to raise funds, and investors lend money in exchange of interest payment. Okay, so for example, in the Philippine government, they issue bonds and people and institutions can buy them. The government then uses the money for projects like building roads, schools, hospitals. In return, investors earn interest. Why invest in debt capital market? Debt securities like bonds are popular because they provide regular income. Investors earn fixed interest payment. Why they are called fixed income investments? These are lower in terms of risk. Unlike stocks, bonds are less risky since companies or governments are legally required to repay the debt. Well, the question is, who invests in debt markets? People who want steady income with low risk. It could be retirees, big institutions like banks, insurance companies that need stable returns. I just recently invested in bonds, so I think this is somehow the same. Okay, what is bond or a bond? A bond is a type of loan where an investor lends money to a company or government in exchange for regular interest payments and full repayment at a future date. Example, the Philippine government issues bonds to raise money for projects like, again, building roads and schools. If you buy a bond, you're lending the money to the government and they pay you interest regularly until they return your full investment at the end of the bond term or the maturity date. So the issuer is the borrower, the government or the company. The investor is the lender. That investor, that lender earns interest for lending money. The bond indenture is the contract. It is the agreement between the issuer and the investor. So a bond is a loan agreement where investors act as lenders, earning interest while waiting for their full money to be repaid later. Bonds are considered low risk compared to stocks. I hope it is very clear to everyone that bond is considered low risk compared to stock. Okay, now let's talk about the bonds that come in different types depending on how they are structured. We have the term bonds. It has one maturity date, meaning the entire amount is paid back at once. Example, a company issues 10-year bond and pays the full amount after 10 years. We also have serial bonds. It has multiple maturity dates, allowing repayment in installment basis. Example, a bond that pays back portions every 5, 10, and 15 years. Mortgage bonds backed by real estate or property as security. Example, a bond secured by company's office building. Collateral trust bond. It is backed by stocks or bonds of other companies. Example, a bond issued by company A secured by shares in company B. Debenture bonds. These are unsecured bonds, meaning they have no collateral. Government bonds that rely on trust in the government's ability to pay. Registered bonds, the bondholder's name is recorded to ensure that only they can receive that payment. Or convertible bond, it can be converted into company shares instead of, being repaid in cash. You can convert it into shares. A company bond that allows investors to exchange it for company stocks. Callable bond, it can be paid off early by the company before maturity. If the interest rates drop, a company buys back bond early to save money. Guaranteed bonds, another party guarantees payment if the issuer fails to pay. Example, a parent company guarantees the bonds of its subsidiary company. Junk bond, it is a high risk but high reward bond issued by financially weak company. Startups with unstable finances, they might offer junk bond with higher interest rate. I hope you understand the different types of bonds. Now, why issue a bond? Issuing bonds is a great way for company or government to raise money without taking a bank loan or selling the company share. It is easier to trade. Bonds can be bought and sold in the market, making investors more willing to invest. There is no ownership dilution, unlike selling shares. Issuing bonds does not give investors ownership in the company. The company borrows money but keeps full control. Alternative to bank loans, bonds often have lower interest rates and better terms than bank loans, making them cheaper way to get funds. Example, if the Philippine government needs funds to build new highways, it can issue government bond instead of taking a loan. Investors buy these bonds and the government pays them back later with interest. Now, when a company or government issues bonds, it sells them to investors to raise money. And here is the bond issue process. Underwriter helps sell the bonds. The bank called an underwriter helps sell the bonds to investors. Bonds can be resold. Investors can sell the bonds in the bond market before they even mature. Bonds trade until maturity. Like if it is a 5-year bond, it will be traded for 5 years. There is also repayment or refinancing. Like when the bond matures, the redemption thing, the issuer either repays investors or issues new bonds to replace it. Example, if a Philippine company wants to build a new factory, it can issue bonds to raise funds. A bank helps sell these bonds to investors. After 5 years, the company repays the investors or issues new bonds to continue financing its projects. So we can also ask, what are the problems that can arise during bond issue process? Sometimes bond issuing can be challenging. For example, if the bond pricing is incorrect, the return that investors will get is not appealing enough, which would discourage them and so affect their interest level. After then, the bond might not sell and the issuer might not be able to raise the required cash. Okay, always remember the 5 golden rules of investing. The higher the return, the higher the risk. Usually, the more danger you will have to assume. Okay, another is diversify to lower risk. Do not put all your eggs in one basket. As much as you can, try to diversify. That is, invest in several businesses and areas to reduce the risk. Short-term savings equals less risk, meaning to say if you're saving over the short term, one should not expose too much risk. You should invest for minimum 5 years. If you cannot, you usually want to avoid investing and keep your money in a savings account. Review your portfolio regularly. A share could be a dud, or you might not be ready to assume the same level of risk as you once could. Ignorance of regular portfolio evaluation could lead to share account losing money. Don't panic. Investments fluctuate. Investments can fall down as well as they can rise. Resist the urge to buy or sell shares only because everyone else is doing it. Well, it happened during the pandemic, right? Now, how to invest? Investing is a two-step process, just like buying bread in a supermarket. You choose a platform. First, you need to decide where to buy your investment, just like picking which supermarket to shop at. This could be a stockbroker, meaning bank is another option, or online investment platform like all of these. COL Financial, pick your investment. Once you have a platform, you choose what to invest in, such as stocks, shares, or funds, just like choosing which type of bread to buy. The things that you have to consider: platforms charge fees, like different supermarkets charging for shopping bags. Some platforms have low fees but higher investment costs, while others have higher platform fees but cheaper investments. Example, if you want to invest in Jollibee Food Corporation stocks, you can use platforms like COL Financial or BDO Securities to buy shares. This platform charge fees, so it's important to compare the cost before investing. And of course, you have to inquire. Magtanong muna kayo, and then you make a decision. Now, what is a share? Shares represent ownership in a company. If you own shares, you are part owner of the business. Pwede kang magyabang. Pwede mong sabihin na, ako ay isa sa may-ari ng SM na to kasi bumili ka ng shares nila. Well, there are 2 ways to earn from shares. Dividends. If the company makes profit and decides to share it, you get a portion. It can be capital gain. If the company's value increases, the price of your shares goes up and you can sell them for a profit. There are 2 main types of shares. Of course, the common shares. Owners can vote in company decisions and receive dividends, but these are not guaranteed. There is also preferred shares. Owners get fixed dividends before common shareholders, but usually don't have voting rights. In simple terms, shares are like owning a piece of a business, and their value can grow over time. Now we have equity shares. These are also called ordinary shares. It represents ownership in a company. If you own equity shares, you are a part owner and share in the company's risk and rewards. Key features of equity shares, as you can see, you have voting rights. Shareholders can vote on company decisions. There's no fixed dividend. Dividends depend on the company's profit. Higher risk, higher reward. Shareholders benefit when the company grows but may lose money if the company struggles. Long-term investment. Equity shares help companies raise funds without borrowing. The advantage or the pros, there is no fixed financial burden on the company because dividends are not guaranteed. It increases company credibility for future loans and the potential for high returns over time. The cons or the disadvantages or the limitations, there is no guaranteed income. Dividends depend on the profit of the company. Issuing more shares can reduce existing shareholders' control and earnings. It can be costly and time-consuming to issue. We can say that equity shares are best for investors who are willing to take risks for potentially higher rewards. So let's talk about preferred shares. Like these are type of company share that guarantees a fixed dividend to shareholders. They have priority over equity shares when it comes to dividend payments. So, capital repayment if the company shuts down. So, ikaw yung priority kung ikaw ay may-ari ng preferred shares or preference shares. So, the key features of preference shares is fixed dividend. Preference shares holders get paid before equity shareholders. Lower risk. They have priority in receiving payments but don't share in extra profit. Limited or no voting rights. They usually cannot vote on company matters. So the types of preferred or preference shares, we have the cumulative versus non-cumulative. Those that are cumulative unpaid dividends carry over to future years. Non-cumulative, if a dividend is skipped, it is lost. Participating versus non-participating. Participating, you can share in extra company profit. But non-participating, you only receive the fixed dividend. We also have the convertible versus the non-convertible. The convertible, it can be changed into equity shares, but non-convertible cannot be converted into equity shares. So why do company issue preference shares? Companies issue preference shares to raise funds without giving away voting control. Investors prefer them because they provide more security than equity shares, but less risk than debt investments like bonds. Okay, so what are the merits of preference shares? Of course, we have to remember that we're dealing to the idea of merits. So you can see here, it has no voting power. Of course, we can say that equity shareholders, they just maintain control since preference shareholders usually don't vote. Stable income, you receive the fixed dividend, making it safer. Investment, priority in payment. You get dividends first. You're paid before equity shareholders if the company shuts down. No assets charged. Unlike loans, preference shares don't use company asset as collateral. But then some of the limitations or disadvantages, it has higher cost. The dividend rate is usually higher than interest on loans. There is no guaranteed returns because dividends are only paid when the company makes profit. Less appeal to risk taker. Investors looking for higher return or high return, they prefer equity shares. So there is no tax benefit as well. Unlike loan interest, dividends are not tax deductible. Preference shares offer stability for investors and flexibility for company, but they are not ideal for those seeking high growth or guaranteed returns. So let's talk about what is a fund. A fund is a pool of money set aside for a specific purpose. It can be used by individuals, businesses, or government. Now, how to fund or how funds work. For individual, it may have an emergency fund for unexpected expenses or a trust fund for a specific person. For investors, it can be by means of mutual funds, we can say, like, for example, diversified investment or hedge funds, high risk, high return investment. For government, you can use funds like special revenue funds to pay for public expenses. Funds help manage money efficiently, whether savings, investments, or planned expenses. So what are you know, the common types of the different bonds? Of course, we have different investment, different types. As you can see, we have to remember that, just to give you additional information, the common types of funds like emergency fund, savings for unexpected expenses, of course. We have like job loss or medical emergency, college fund, tax advantage saving plans, for example, trust fund administered by trustee for a beneficiary, retirement fund, savings for retirement, proving or providing income or pension later in life. Investment funds can be mutual funds, money market funds, exchange traded funds, hedge funds, government bond funds. For example, the mutual fund, it is like a professionally managed fund that invests in stocks, bonds, or other assets. Money market fund, it is a low risk fund that invests in short term securities like treasury bills. The exchange traded fund, a fund that trades on stock exchanges like regular stocks. Hedge fund, these are high risk, high return investment for wealthy individuals or institutions. Government bond fund, a low risk investment in government securities like the one I've mentioned, securities like treasury bonds. Government fund like debt service fund, it is used to repay government debt. Capital projects fund used for infrastructure project like roads, highways, building. Permanent fund investments that generate revenue for government functions but cannot be spent. These funds, that all of these common types of funds, it helps individuals, it helps investors and government manage money effectively for specific financial goals. Okay, so non-monetary resources like property, plant, and equipment. These are long-term physical assets that a company uses to generate revenue. These assets are tangible, meaning they have a physical presence and help businesses operate efficiently over time. Examples of the property, plant, and equipment assets, building and land, offices, warehouses, factory sites. Machinery and equipment, tools, machines, technology used in production. It can be vehicle, company-owned trucks, cars, delivery vans. It can be furniture and office equipment like desk, chair, computer. The property, plant, and equipment asset from inventory are investments because it is not easily sold. However, it is a key part of the company's financial planning because it helps generate profit over many years. Unlike other assets, land does not typically lose value over time. It does not really depreciate, while other physical or other property, plant, and equipment assets do. Okay, these are the references of this topic, monetary resources, and I hope you were able to learn something today. And please do not forget to review your module. Thank you for a very productive day, everyone.